My guest today on the Alpha Exchange is Megan Miller. She is a senior portfolio manager and head of the options solutions team at Allspring Global Investments, a money manager helping institutions like endowments and insurance companies achieve their financial objectives. Megan, it's great to have you on the podcast today.
Thanks for having me, Dean.
Looking forward to our conversation and glad that Mandy Zhu of the SIBO introduced us.
Yes. Yeah.
So this will be a fun conversation. Overwriting, which is one of your specialties, is definitely getting a lot of attention. There's been this big democratization in ETFs. I just came across this ticker, the IQQQ, which apparently overwrites triple Q with daily options. And so there's all kinds of ways to achieve some version of overwriting. And we'll talk about the approach that you guys take on behalf of your clients. But let's first learn a little bit about you and your career history. Tell us about the early days in your career and how you got to Allspring.
So I got my start as a options-based researcher based off an internship that I had in Los Angeles. I was at the time studying mathematics at UCLA, and I was able to do an internship at a boutique asset manager called Analytic Investors. I did options-based research, looking at different options-based attribution, volatility, forecasting, anything related to options and derivatives. I focused on as a researcher. From there, I moved to the trading desk. So I did work alongside of our equity and option traders, and I helped trade our option strategy. So I was doing this during the global financial crisis, and it was incredibly stressful because of just what was going on in the market and how young I was in my career, and just seeing stocks melt and the markets melt. And it was a very stressful time to be an options trader. So that didn't last long, and I moved to the portfolio management side. So all of this is with the same firm that eventually got acquired by Wells Fargo Asset Management, and which is now Allspring. So through a series of acquisitions, I'm still with the same team, still with the same options team now under Allspring Global Investments. And so it's the same team that I'm now leading, and we manage options-based strategies for a variety of clients, institutional and retail investors. I wear a few more hats at Allspring, so I also co-lead our custom SMA team. And this team supports our custom SMA platform called Remy. And through Remy, we manage tax managed and customized manager traded SMAs. And my last hat at Allspring is I am our chief operating officer of our equity platform. So this is my newest role with the firm, where I am focused on platform excellence for all of our equity teams. And so Allspring, a little bit more about Allspring, we're a $600 billion asset manager with almost 100 years of experience in public markets. And so we have, like I said, 600 billion assets in fixed income, equity, multi-asset options. And we do this for a variety of clients. And so where I began my career with a small boutique asset manager, we're a much larger asset manager with a broad investment base. And so in my newest role as equity COO, I'm focused on delivering a efficient and technology advanced platform for our equity teams, which includes our options team as well.
Well, the diversified nature of your responsibilities there is going to give us a lot to talk about. And, of course, overwriting is a trade. That's a risk exposure. But I think where you're going to take us is that there's a lot to think about in terms of efficiency of implementation, tax consequences, the technology aspects. So I'm eager to get into that. And as you gave a little bit of your background, I couldn't help but think about the financial crisis. I was just having a conversation with a student yesterday, and I was explaining just around how, unbelievably volatile that period was. And I'm just remembering there was one day in early August of 2008 where the authorities woke up and said, we have to ban short selling in financials. And I want to say the XLF was up 18% that day. So if you're short calls or if you're long puts or anything like that. It's the whipsaws were extraordinary. As you described your early days and the focus at analytic investors on vol forecasting, I find that really interesting. I'd love to learn a little bit more about that. It's almost like we do the reverse of it now. We just look at realized vol and think that's a number, but of course that just came and went. So we look backward, and you seem to be implying a goal of looking forward. And to the extent you can talk about that or describe that, I'd love to learn more about that process.
Yeah. So our thesis in managing option strategies is that we um, create option strategies that we believe will perform in the long run. And we do that by purchasing options that we believe are underpriced and selling options that we believe are overpriced. The way that we make this assessment is by forecasting volatility. And so our forecast of volatility is multi horizon. So we can look at any expiry in the option chain and have a forecasted volatility for any of the options and underlines in our universe. And this forecasted volatility does utilize it's a time series model utilizing a GARCH-like approach with proprietary specifications that we believe better forecast future volatility. And like I mentioned, this is the thesis and the belief that we utilize for our option strategies. And through this, we're able to create a expected return for all of our option positions. And so the reason why we do this is because the volatility evaluation and if it's overpriced or underpriced looks different for different underlines. And so what we've seen through our research is higher volatility names have a higher volatility risk premium. So high vol name are correlated with high VRPs. And so you can't just compare a high vol VRP to a low vol VRP and say one is better than the other. You need to create it into an expected return in order to compare apples to apples, because without it, you're comparing apples to oranges. And so by converting everything into an expected return and comparing the market's forecast for future vol, which is the implied, so comparing the market's forecast to future vol to our forecast to future vol, we're able to determine if options are underpriced or overpriced. And those are the ones that we select for our portfolios.
Yeah, the market kind of gives you some tells about what's coming. Not 100%. There are those times. The VIX event of 2018 was a 10 VIX to 35 in a couple days. I want to say there was August of 2015. There was just a gigantic increase in vol in a very short period of time. But generally, there's a little bit of a buildup where you start moving 1% a day in the S&P, and then you get to throw 2% in there. It's kind of the market telling you that the environment's changed a little bit. And I'm wondering, just when you mentioned a GARCH type time series model, is it incorporating some sense of, hey, we've had some change in the daily motion, let's say, and we'll just use the S&P as an example. Is that at least in some part of what it's picking up on in terms of making a future forecast?
Yes. So it's the model specifications look at both short run volatility and long run volatility. So the long run factor in all GARCH processes is that vol decay. So if vol spikes, we believe that it's mean reverting and will come back down to the long run mean. And so that's the long run component in the GARCH modeling. But our model also incorporates short term and short run volatility spikes. And so it will capture everything from the 1 day move and the initial moves in comparison to the long run move. So yes, capturing both short run components and long run components in order to effectively model the decay of the volatility move.
While we're on this topic, you've been doing this for a while, and I just can't help but, as you talked about almost the cross section of VRP, low vol stocks and high vol stocks, there's also regimes of VRP. You kind of referenced it. So take a 2017 where the VIX might have averaged 11, I think, for the year, realized average 6.5. And then take a GFC where you got your start, at least on the options trading side, or COVID. So you've had experience through these, impossibly low and impossibly high VIX regimes. Any just big picture takeaways around how you have to think differently depending on, especially at the extremes, what sort of decision making tends to be more important in a very low versus very high vol environment?
We actually think about it a little bit differently because we're systematic investors. And so, systematically, we do create strategies that are able to withstand the various volatility regimes. And that is part of our risk management. And so, create a strategy that works in various volatility regimes, whether it's high or low, create a portfolio that is able to perform in those different environments. And so, as opposed to a manager that would be changing different structures or making different decisions in different regimes, we do take a consistent approach. And that's part of our systematic philosophy of really just creating a strategy we believe will perform in the long run through various market regimes and market cycles.
Give us a little bit more of a sense as to the product at Allspring. I led off by talking about this IQQQ. It's overriding one day. Some people, there's strike selection, of course, the underlying asset. Give us just a big picture of what the product looks like. I'm sure there's more than one product. And then, the deliverables on behalf of your investors. What are you hoping to achieve on their behalf?
All of our strategies are outcome based. And right now, the strategies that are most demand are income based strategies, so equity income. And so most of our lineup right now is focused on equity income. Over the years and through the time that I've been involved with the team, we've done anything from hedging all the way up to income. So we do and have the capability to manage the full suite of option based strategies. But like I said, right now, the focus has been on income. And I think in part because of the popularity of some of the ETFs that you mentioned and some of the other ETFs that are out in the marketplace that have the option embedded income as part of their solution. And so we deliver similar strategies to our clients. And these are based on both US and global equity strategies. So we have US products and we have global products all focused on generating additional income and additional yield for our clients. And we do this utilizing index options. So these products are in the income index space, and we again select our option positions in the basket of options that we use to generate income. We select those options based on our volatility forecast and expected return. And we select those options based on the risk of the underlying equity portfolio. So it's important for us to create a basket of options that track the underlying equity in order to create a portfolio that performs as expected. So your traditional covered call portfolio, but in this case, the equity portfolio is an active equity portfolio delivered by our active equity teams here at Allspring. The options are managed by our options team here at Allspring, where the options track the underlying active equity portfolio.
And when you say outcome based, does that mean you're holding the options to maturity and letting them expire? I'm not clear on that term.
The outcome is, what are we trying to achieve for the client? So as opposed to we're running covered call strategies, it's just a reframe to showcase what we are delivering to the client. So we're delivering income. We're delivering strategies that enhance income or enhance the yield. If they're hedging based strategies, we're providing strategies that provide protection. And so it's a reframe on the discussion with the client to better set expectations of what they should expect in their portfolio. To give a little bit more context to why that we believe that's important, when I started my career, we had a very different client base than we have now. So when I started my career, we were focused in the institutional channel. And we only worked with the most sophisticated investors and mainly through consultants. Not a lot of our clients really understood options, understood the risks and the opportunity for return. And so a lot of this conversation was via a consultant who did the translation, working with our firm and back to the client. Now, the client landscape is so different, and we're delivering these strategies to retail investors, and the institutions themselves don't necessarily need a consultant to do the translation. They understand the strategies as well now. And that's really thanks to a lot of the education being shared over the last, few decades, whether it be through SIBO, like you mentioned, or through podcasts such as yours, and just really, even the derivative section in the CFA test, all of these ways for people to start learning more about options have really opened up our client base and the opportunity for us to deliver option strategies to more clients.
What would you say as you sort of look back on the time you've been doing this, are some of the maybe changes in your process or ways of implementing that you've incorporated as a function of whether it's feedback from the marketplace, feedback from clients, risk episodes? What's what are you doing? We're going to talk a lot about, the technology aspects of implementation, but just the trading aspects, staying true to that core vol forecast, but perhaps having some tweaks in the trading process along the way. Can you highlight one or two of those?
Actually, not much has changed. Our philosophy and models have stayed the same. And the way we create our portfolios have stayed the same. They've been enhanced with technology, which we can get into. But in terms of how we create the portfolios, our philosophy, um, making sure our options track the underlying, making sure we're buying and selling the positions that we believe are under or overvalued, that has remained the same. Some of the things that have changed from the trading perspective is really just the we've moved from high touch to low touch in trading, and so that's made a big difference in terms of transaction costs and the speed to execution. And some of the work that our trading desk does here at Allspring is enhanced and advanced transaction cost analysis. So we've been evaluating that for decades now and really understanding what it looks like from an options perspective, which was has been rare, although more firms now are providing TCA for options now. But in the past, we did a lot of that work on our desk, and you could see the difference in options based transactions, really just because of the change in picking up the phone and creating asking and directing the options order versus doing it now electronically and through algo bills and almost automatically. And so that has been a big change in the way we execute our strategies. But in terms of creating the portfolio construction and everything that's done before execution, that's remained relatively the same. And I think it's because of our systematic nature. And so because of the very rules based architecture that we develop our strategies, create our strategies, that's remains consistent.
You mentioned some of the underlyings are non-US underlyings. Certainly, and I've always said this, the option trading technology for US equity derivatives is just about the best in the world. I mean, it's just amazing what you can get done, how cheap it is, how liquid things are, remarkably transparent. So that's a fact. That's just great technology. Other markets don't necessarily have as advanced a technology. I'm just curious, the implementation in US versus non-US underlyings.
We can all agree how liquid and substantially far surpassed the S&P is compared to everything else that is in our portfolio. So besides the S&P and S&P options, we do have a variety of liquidity metrics that we look at for all of the other positions in our portfolio. And so even some of the US names that we trade that help us track our underlying equity portfolio are a lot less liquid than the S&P, just because the S&P is off on its own. And so we do have to monitor the liquidity of the names that we transact in. And I'd say even some of the smaller US names are less liquid than the global names that we transact in. And so our global names, all index options, we transact in the most liquid, Euro stocks, FTSE indices. And so because we're in various parts of the market in various regions, we are looking at liquidity and having that be part of our process. The interesting thing to note from an implementation perspective, you mentioned, is each exchange has a different settlement process. And so not all of the options settle, in the morning or in the afternoon. Everyone has their own. It's not as standard as it could be, which makes the implementation a little tricky. And so, when we go out in the global markets, we need to understand the unique settlement instructions for each of the different markets that we trade in. And so, it does take basically a mapping of all of the rules and all of the timing in order to transact in those regions.
So everyone's overwriting product is a little bit different. I mentioned again that 1 day overwrite. I'm assuming you're not doing 1 day overwrites. Not, I guess there's one out there. But with regard to your client base and the deliverable, again, the kind of risk return deliverable that you're seeking. Of course, when you overwrite, you're reducing your delta a little bit. So I'm going to guess that the beta is less than a market beta. That's kind of by design. I'm just curious if you could open up a little bit on how you think about the risk return trade offs when you use the overwriting product.
In our income strategy, I'll speak specifically on our global strategy. It's a part of a UCITS. It's a UCITS Lux fund. And in our global product, we're really trying to outperform the market. And so the overall product, both an active equity portfolio and the options overlay, our objective is to outperform the market, even though we do have a lower beta. And that overperformance is via our alpha in both the equity strategy and in the option strategy. Over time, expectations to add income through the option portfolio. And so this is a yield-based strategy, and we deliver the yield both with equity dividends, and option income. And the combination of those two, targeting a 6% yield for our fund and the clients within the fund. And the expectation is over the long run. So obviously, various market cycles will have different outcomes, but we've been very pleased with the performance that we've achieved since launch. I believe we're in our fourth year in that strategy, and so over the last 4 years, we've been happy with the performance and those expectations. And so we are, in order to achieve that, writing further out of the money than closer to the money, which is, I think, what you were trying to get at with your question. And so the objective is really to outperform, add income. And so we do that with a further out of the money portfolio.
So we talked a little bit about just the democratization of these products. Boy, most of these new ETFs have some special flavor to them, right? It's a 2x levered, long or short, and very, very often now, it's got some embedded optionality. Walk us through kind of that aspect of the, kind of change in the industry. It's a big land grab for assets. You guys are coming at it from a more traditional SMA type of approach. How does your product, kind of interact with the landscape of these overriding products?
We're doing it in multiple fronts, and I think we'll continue to expand on this as well. We've always have a long history with mutual funds, and so we do have option-based equity products or option embedded equity products in our mutual fund lineup. We've also introduced manager traded options SMAs, and so we have that in our lineup as well. And I mentioned our UCITS and fund for our global strategy, and so we have found success in these commingled fund-like products. And so the area that we're excited about is the ETF space. And so Allspring, over the last year, has launched 8 active ETFs. And these active ETFs are in the fixed income and equity space. And we do have plans for continued expansion there. And so in terms of delivering to that new landscape in the retail market, currently from an options perspective, we're delivering through mutual funds, UCITS funds, and SMAs. So we're excited on how we can further expand those vehicles in order to deliver more to our clients.
And what does that kind of build out look like in terms of moving from, we're not moving from SMAs, but expanding, continuing SMAs, but also adding this new suite? Walk us through, the early days of deciding to do that, and then your role, which is a kind of a heavy lift in trying to get the technology right, the operational aspects, I'm sure, were, considerable. I'd love to just learn a little bit more of like getting that off the ground.
It's interesting. I was thinking about this the other day when I had my start in my career and I moved from the trading desk onto the portfolio management side of the firm. Some of the value that I brought was introducing technology into the workflow. And so I was able to take what the teams and the portfolio managers were doing for years, take that, improve it with technology, increase our time, our speed to invest tenfold, 15-fold, and really just transform how we were doing things via technology. And so that was almost 20 years ago. And I'm seeing the same thing being done now. We have more junior people coming in, taking a look at what we're doing and saying, you know what, we can do this a lot better or a lot quicker. We should use this tool. And so we have this opportunity to, again, transform our workflows to make them more efficient, more effective, being able to help our portfolio managers deliver more and better outcomes for our clients. And through this, we're able to deliver more customizations than we can. And so if you think about in a world where you're not utilizing technology as well as you can now, you're not able to do the customizations clients are need or the tax management. All of that takes very sophisticated technology to do all the mapping, to do things quickly. Otherwise, you're spending a whole day on one customization. And so you need technology in order to do these customizations and tax management requests that we're seeing from the retail channel. And it's not just the retail channel, our institutional channels looking for tax management and customization as well. And so as a firm, what we're doing across the investment platform is enhancing our platform to be able to deliver these customizations, deliver this tax management across all of our vehicles. And so we are very focused on that. And Allspring as a company, we became independent 4 years ago. And this was through an acquisition out of Wells Fargo Asset Management. And I mention this because through that independence, we had an opportunity to invest more in our technology. And so over the last 4 years, we've invested heavily in our technology in order to take that opportunity to transform the platform in order to do this, in order to deliver more customization, deliver more tax management, deliver a more efficient portfolio management.
And the customization on things like SMAs, what does that look like? Is that I'd like a customized trading approach?
Usually a customized portfolio. So, for example, client doesn't want a certain sector or a certain position. So we have these, if you think of an executive that has a lot of Apple stock, for example, they want a direct indexing portfolio, but without any Apple because they have a lot of exposure to Apple. So that's just one example of a portfolio customization, but we also have more values-based customizations or tilting, factor tilting. So that's on the direct indexing space. But in terms of options strategies, we could customize the portfolio to certain yield or hedging targets. And so customizing how the option portfolio looks from that perspective. And so just the ability to apply these various customizations that are predetermined. So the client can't come in and say, I want, XYZ. It's a predetermined menu of things that we've built in order to customize. So mainly they're portfolio customizations. And then you could think of it from a tax perspective as well. The tax overlay or the tax management is another form of customization where we're taking the portfolio but trading it with respect to gains and losses.
When you look at the requests for customization, you mentioned some are, values based. I'm wondering if the market environment that we came out of matters. We talked a little bit about the global financial crisis. Folks were rightly very concerned about taking risk for a long time afterwards, and so perhaps hedging becomes a real thing. And I certainly can remember in 2010 and 11, there were just a lot of hedging mandates. It makes sense to pay away put premium because of disasters like the GFC. And then we go through, of course, long periods where nothing happens and people tire of paying away put premium. Does any of the requests for customization, is it linked at all to the environment we, either have come out of or are entering into?
Yes.
Okay.
Yes. And I mean, we definitely see the same from a client. I mean, that's our client demand, right? So we do see fluctuations in the client demand based on the market environment. And so exactly as you say from a hedging perspective, still to this day, I mean, there's some interest now in hedging strategies, just with the vol market and concerns that we're seeing with either the AI bubble or the interest rate regime or the tariffs, and so some of these recent events have had clients start to begin thinking again about hedging strategies, but it's very cyclical and based on what has happened in the market. So that short look back bias, it does really come through and translate to our client demand. And so right now, most of our strategies are income, and that's chasing the higher income back from when yields were still very low. But if we see a market correction, I do think we'll start seeing more demand for the hedging strategies, and we'll start the cycle from that perspective.
I just was thinking that, one of the very popular trades in the hedge fund space is this dispersion trade. You sell index options and you buy single stock options, and the pricing of that is pretty skinny. There's not a lot of room for error, but it's been a consistently good carry trade. And tell me if this is correct, but it's almost like you're benefiting from something similar, which is you're overriding with index. And so you get these gigantic moves, whether it's Oracle or Nvidia, that are more idiosyncratic than not, right? So you get the stock fall, but a lot of it, I don't want to say cancels out, but you don't see it follow through as much on the index side. Is that something you guys see or explicitly trying to capitalize?
Yes. And also, as part of that argument, is we're allowing the security specific alpha of the underlying equity portfolio to come through. So, from a risk, what you mentioned was from a risk perspective, but similarly, from an alpha perspective, by writing index options, we're allowing the stock selection and the expertise of our equity managers to further come through in the returns of the portfolio, because we're not capping any of the upside from the security selection.
So I'd love to just learn a little bit more about the implementation process, because it just seems to me that overwriting, anyone could fire up their interactive brokers account and sell a call option against something they own, right? If only it were that easy. And I'm sure it's very competitive. Financial markets find a way to just reduce cost and deliver something that needs scale and it needs efficiency in order to make it work. And I'm sure that's been a big part of what you and your team have been after in terms of making the process more efficient. Just walk us through a little bit more about that, where your attention's focused on continuing to try to enhance a process that obviously you've already spent a lot of time on, but I'm sure you've still got things on your mind in terms of making it better from here.
I do. I'm, I guess, never satisfied and always looking for the next thing to improve and the next thing to do. So that is true. But from a investment platform perspective at Allspring, our history is a series of acquisitions. And so all of our teams have come together acting within our siloed teams with the technologies that we brought in from our predecessor firms. And a lot of that's gone away now. But that is the history of how we were to become Allspring Global Investments. And so over the last 4 years, we've made a concerted effort to start knocking down all of those silos between the teams and having a more consistent investment platform, that just making things consistent and utilizing the same tools and doing and really leveraging the best practices of the various teams in terms of a tooling perspective and a PM tooling perspective, technology perspective, we're able to create a more efficient platform. And so a lot of my work now as the equity COO is really understanding all of the various tools that the different investment teams are utilizing in order to manage their portfolios, in order to create, do the portfolio construction, to do the research, to do the portfolio construction, to do the execution, all of the steps in the portfolio management process. How can we do them better? And I make that assessment by working with all of the teams and understand and making a judgment on what is our best practice and making sure that all of the teams are utilizing that best practice approach. By doing that, we'll effectively improve our process, make it more efficient, make sure all of the teams are using the best tools at their disposal. And doing this will allow the PMs to be more focused on adding value to our clients. And so we're focused on the equity side. I have a counterpart on the fixed income side. So I'm focused on our equity strategies and our option strategies. I have a fixed income counterpart that's doing the same for our fixed income platform. And when we're done, we'll have a very the top of the line efficient investment platform that our teams are running off of.
You had referenced earlier just the idea of education, and I feel like it's a ongoing, almost never-ending, pursuit to try to help the clients understand the strategies better. I'll tell you a little story. I was at Bank of America something like 20 years ago, and I was doing a presentation. I was the derivatives guy. I was doing a presentation to our equity team, and it was going to be about how fundamental portfolio managers are using options more. And so I went on Google and I did some search, and I found some piece that was just so spot on. I read this thing. I was so excited. I was going to bring this to the meeting. And right at the end of the article, it said the piece was from 1993. So it's not as if, this the education process has not been around a long time, but it does feel like folks are learning more. If you go back even to the GameStop incident, which is kind of an ugly incident, but when you went on Wall Street Bets, you realized these folks know a fair amount about how options work. It's the retail community is far better educated than maybe the assumption is. What do the client education efforts look like for you and for your team at Allspring?
It is very important for us that our clients understand the option strategies that they're investing in. We do not shy away from that education, and in fact have specialists dedicated to working with our financial advisors on our option SMA strategies. And so in the SMA, in the retail SMA space, we have specialists dedicated to working with the financial advisor who's representing the retail client. And through that relationship, we're making sure that they understand the expectations of the option portfolio. And these option portfolios we're talking about are, the simplest form of the option strategies. It's the cover, it's the cover call strategy, the one that goes back to the beginning of options, and hopefully is the most understood option strategy out there, and maybe alongside just buying call options. As an options manager, it's not one of the most complex things that we do. We're selling calls, and the payoff profile is relatively easy to explain and hopefully understand. But nonetheless, we do believe it's important that the client truly understands. A lot of the strategies, we do have to have an assessment of the client to make sure that they do understand the option strategy before they invest in it. Similar to some of the trading platforms where they evaluate if you're knowledgeable on options or not before they approve you for an account. we do similar screening for various products.
So you've got a number of different responsibilities on the kind of product development side. Are there one or two initiatives or early experiments that you guys are looking at that you think might hold some promise that you can share?
I mentioned the ETFs. So I am excited to see what we roll out from the ETF space. We are, as a firm, committed to delivering more of our strategies in all of the various vehicles that help clients. And so we do believe in our strategies and believe in active management. And I mentioned we have almost 100 years of experience, and that's with mutual funds. And so we are heavy in mutual funds and are committed to making sure we're offering relevant vehicle types for where clients are at today. So we're very excited about our ETFs and excited to further expand that lineup. So that's what's on the radar for 2026 in terms of products and in terms, my other hat in ensuring platform excellence. We're committed to that for 2026 as well.
So you've been doing this for a while, not as long as I have. What would some advice be that you might give someone like yourself who is entering is now thinking about entering our great industry of financial services? What might you tell a young person who's in their senior year of college that's contemplating a career either on the buy side or the sell side or some version of financial markets?
What I appreciated through all the various things that I've done throughout my career is that there's always an opportunity to learn. So no matter what you're doing, there's an opportunity to learn. And I mentioned my short stint on the trading desk. It did last 2 years, although it felt like it was forever. I did learn a lot through that experience. And so there's always something that you can take out of the role you're doing. And so I started as an intern, and actually my first job as the intern was answering the phones at the front desk. And now I've found my way to the various roles I have at Allspring. And so there's always something to learn. There's always someone to learn from. And the mentors I had and have, they've changed. Whoever you're working with at the time, whatever role you're in at the time, those mentors change and evolve. And I think just that opportunity to learn is out there no matter what role you're in. And so the advice is just being open to those learning opportunities, being open to the various people that you work with. Anyone and everyone can become a mentor. It doesn't necessarily need to be the lead PM or the head of X, Y, and Z. It's anyone and everyone can be a mentor in your career journey, and just listening and learning from them and their experience is critical. And I truly value the internship opportunities we do have. What we think of at Allspring, the next generation talent, and making sure that we are bringing in people that can help form that next generation of leadership. And that's how I got my start, and that's how a lot of people that work with me and for me they were interns, and they're some of our best performing people on the team. And so that eagerness to learn is critically important.
Well, your overlap on the trading desk could not have been during a more frenetic time. I'm thinking if you sat on that same desk from 2016 to 2017, it would have been
You're right.
vastly different. So the market can teach lessons, but it sounds like
Yes.
perhaps it's the corporate culture you've grown up into, but your experience with learning from those who have been doing it has left a very positive impression on you. And seems like you think a lot about that now, where young people come into the firm and you try to, make yourself available to teach them.
Yeah, that's right.
There's so much to learn in this industry. And it's so interesting that you got your start as an intern. Well, it has been a pleasure to connect with you. I've really enjoyed the conversation. And I think the idea has been really that, overwriting is a relatively basic trade, but there's just a ton more to it to actually do it at scale in a cost efficient manner that works, on behalf of the clients. And it sounds like that's where one of your, true areas of focus. So Megan, thank you. Thank you for being a guest on the Alpha Exchange podcast.
Thank you, Dean.